Hello and welcome to the Weekly Outlook at XM.com. I'm Maria Pachordes, and joining me is investment analyst Marios Hadjikyriacos. We'll be taking a look at the week ahead. So Marios, over the past few weeks, there's been a flood of stimulus from central banks and governments, and there have been announcements of plans to reopen many economies. How are markets doing overall at the moment?
Hello, Maria. Yes, indeed, we've seen a flood of stimulus. We've also had some positive signals about a potential virus treatment, and we've seen the plans to reopen many economies. And the combination of all these three has markets in a very cheerful mood at the end of April. However, I'm not that optimistic. I'm looking at commodity markets and they're sending a very different signal. So they're much gloomier about the prospects of the global economy. So specifically, oil prices, they're still in the dumpster. They have recovered a little in the last couple of sessions, but they're still very, very depressed. At the same time, gold prices are holding near 8-year highs. And the commodity market is basically sending a very different signal from the stock market. And I'm siding more with the commodity market. And the reason is the commodity markets are less influenced by central banks. So stock markets and bond markets are very sensitive to what central banks are doing. But commodity markets are a much better reflection of true demand supply fundamentals, and those are sending a much gloomier signal about the global economy. So I believe that the risk of another pullback in stocks from here is quite elevated. The current stock market valuation implies a very quick recovery for the global economy. However, I think that's pretty unlikely. So first of all, we are going to see a lot of businesses go shut down permanently after everything is said and done. And then you have to think about the impact on consumption from soaring unemployment. We're going to have a lot of unemployment even after the lockdowns are lifted, and that will keep a lid on consumption. And finally, there's also the behavioral shock. A lot of consumers are going to be very defensive with their spending even after things open up, and we're already seeing this in China. Consumers there are slowly dipping their toes. They're being more cautious, and I think that will play out in the rest of the globe as well. So the bottom line from all of this is that I think that the stock market is underplaying the real magnitude of this crisis, how long it will take for us to recover, and what the long-term damage will be. And we've seen a lot of optimism being priced back into stocks. So I believe there's a lot of room for disappointment from here if anything goes wrong, and that the risk of another turn lower in stocks is dangerously high.
Right. Now, on Friday, we'll get non-farm payrolls data out of the U.S. Are these figures likely to give us a clearer picture as to how much economic damage the pandemic has caused?
Yes, they will. So the US economy is expected to have lost 20 million jobs just in April, which would push the unemployment rate up to 14%, which is much higher than the 10% peak of the last recession. So that sounds bad, but it's even worse when you consider that this survey was done in the second week of April. And ever since then, we've gotten more worrisome labor market data. So that means that the real unemployment number today is probably much higher than whatever next week's data will show us. So what does all this mean for the dollar? We might see the dollar take a hit if the US data are disappointing next week, but overall, I'm still optimistic on the currency. I think that we might, the risk of another period of risk aversion is very elevated. And if that happens, that could bring the dollar back under demand because the dollar is the market's favorite safe haven in this crisis.
And finally, the Bank of England and the Reserve Bank of Australia are meeting next week. Are they likely to deliver anything new?
I don't think so. They've both done a lot lately, so they are unlikely to act, but they are likely to maintain a very dovish tone. So both of them will probably say something along the lines of, we are still here, prepared to do even more if needed. Now, I think that the Reserve Bank of Australia will be especially dovish. And the reason for that is the currency, the Australian dollar. We've seen the Aussie recover quite substantially lately for different reasons, mainly because Australia has handled this whole virus crisis much better than other nations. But the bottom line here is that the stronger currency doesn't suit you if you're a central bank right now. So I think that the Reserve Bank of Australia will have a lot of incentive to, let's say, talk down the Australian dollar next week. Now, if they don't, that will push the Aussie even higher, and that's probably the last thing that they want right now.
Marios, thanks so much. And thanks for joining us at XM.com.